Welcome back to Trader DNA. Let me introduce you to the 4 most important volume and price movement anomalies that every trader needs to recognize. Alright traders, look at this chart. Up here, this right here is the price chart. If you're even remotely familiar with trading, you already know this is where all the action happens. But if you're new or you just never paid attention, this is the indicator that traders use to analyze market movements. From here, they execute strategies, whether it's indicator-based analysis, price action, market structure, order blocks, or even the supply and demand approach. But wait! Down here, this is where things get really interesting. This is the volume histogram. And this, ladies and gentlemen, is the lifeblood of the market. This isn't just another indicator. Nope. This is the engine that drives the entire market forward. Now, generally speaking, when you see a bullish candle green, the volume histogram also turns green. And the taller that histogram is, the stronger the buying pressure. Makes sense, right? The bigger the price increase, the more volume behind it. And if the price moves slowly or candles get smaller, the histogram shrinks as well. On the flip side, when the market is bearish red candles, the volume bar usually turns red. The bigger the drop in price, the taller the red volume bar. And if the price barely moves, the volume stays low. Simple, right? But here's the shocker. The market doesn't always follow this rule. Price movements and trading volume do not always go hand in hand. Just because a price is moving up or down significantly does not mean it's backed by high trading volume. And just because there's a huge spike in volume does not always mean the price will move dramatically. That's right. The market can make small price movements with massive volume backing them, and vice versa. It can make huge price moves with barely any volume at all. This, my friends, is what we call a volume and price movement anomaly. It's when the usual relationship between price movement and trading volume is broken. And this is where traders can get a huge edge. Understanding these anomalies is absolutely crucial for figuring out who's really in control of the market. And when these anomalies happen at key support or resistance levels, they become a game-changing tool for deciding whether your buy-sell entry is actually backed by the market, or if you're walking into a trap. Now, let me introduce you to the 4 most important volume and price movement anomalies that every trader needs to recognize. First, high buying volume, but a small bullish candle. Second, low buying volume, but a massive bullish candle. Third, high selling volume, but a small bearish candle. Fourth, low selling volume, but a massive bearish candle. These 4 anomalies are absolute gold mines for traders, and if you spot them at a key support or resistance level, then congratulations, you just found a trading jackpot. Don't worry, I'm going to break down each one of these anomalies in detail so you completely understand how to use them to crush the market. Anomaly number 1, high buying volume, but a small bullish candle. Sounds weird, right? If there's a ton of buy volume, shouldn't the price shoot up like a rocket? Well, not necessarily. And that's what makes this anomaly so important to understand. 1. Understanding high buy volume and small bullish candles. A high buying volume means there's a massive amount of buy transactions happening in a given period. It signals strong interest from traders and investors who are eager to buy. Implication. Normally, when we see a high volume, we expect that price movements, whether up or down, are backed by serious market participation. So in theory, if we see high buy volume, it should mean a strong uptrend is forming. But wait, there's a catch. Small bullish candle. A bullish candle forms when the closing price is higher than the opening price, meaning the market moved up. But if the body is small, it means the price difference between opening and closing is minimal. Implication. Even though buyers are active, the price isn't surging the way you'd expect. This tells us something is holding back the momentum, and that is where things get really interesting. What happens when these two occur together? Now, let's talk about what's really going on when you see high buy volume but the price barely moves. This anomaly can reveal 3 major things. A. Buyers and sellers are battling it out. Tons of buyers are stepping in, but price action is limited. This means sellers are absorbing the buy orders. There's a tug of war happening and neither side has full control yet. This scenario is common when the market is in a consolidation phase, meaning price is stuck in a tight range, waiting for a breakout. B. Market accumulation or consolidation. Big money players, institutional investors and whales sometimes buy in phases to avoid pumping the price too quickly. So even though volume is high, price doesn't skyrocket because they're slowly accumulating. This is why markets often have periods of sideways movement before a big move happens. Smart money is loading up before the breakout. C. Weak bullish momentum equals no real strength. If price barely moves despite a surge in buy volume, it means buyers don't have enough power to push the price higher. This could signal a lack of conviction or even an upcoming reversal. If resistance is too strong and buyers can't break through, the market might turn bearish instead. Real world example. Let's say a stock opens at 1,000 with massive buy volume. Orders are flying in, but the price barely moves, closing at 1,110. What does this mean? Even though tons of people are buying, sellers are pushing back just as hard. Instead of price soaring, it barely moves, suggesting the market is in a holding pattern. This is not a full bullish confirmation yet. The market may be consolidating, accumulating, or even setting up for a reversal. So if you enter too soon, you might get trapped. This right here is the kind of market setup we're going to break down today. I'm about to show you exactly how you should read market movements based on the key principles I already explained in last week's video. And listen, if you haven't studied that video carefully, you need to go back and watch it because everything we cover today builds on that foundation. Alright, now let's combine these principles with anomaly number 1, high buying volume but a small bullish candle, and see how we can use this to skyrocket our trade accuracy. Look at this chart right here. We've got a super clear bullish trend. The market structure tells the story. Price moves up, pulls back, pushes up again, then pulls back deeper but still forms a higher low before bouncing back up. This meets principle number 2 because we can now spot a strong key support level that holds significance when the market pulls back. And this is exactly what principle 3 is about. The market is showing exhaustion as it moves toward key support. Now, look at this. The market hits that strong support level and bam, a bullish pin bar forms. But, and this is crucial, like I said in last week's video, we don't care about pin bars or any candlestick pattern by itself. That's what makes this strategy so insanely powerful. There's no need to memorize a million patterns like you're cramming for a test. Instead, all you need is a deep understanding of how the market moves and discipline to apply that knowledge flawlessly. Alright, back to the chart. Now it's time to analyze the market's energy using the trading volume, represented by the histogram below the chart. Let's take a closer look at this pin bar. Notice how it has a tiny body, meaning price barely moved, but the volume histogram is massive and blue. This right here is textbook anomaly number 1, high buying volume but a small bullish candle. And guess what? It's happening right at a strong support level in a strong bullish trend. So what does this mean? This tells us that big money institutions, hedge funds, the whales of the market are accumulating. They're buying in huge amounts, but they're doing it stealthily without causing a massive price spike. Why? Because they're carefully building their positions before making their big move. And if institutions are confident enough to load up, that means they're expecting price to launch. But wait, there's more. Let's analyze the market's previous behavior at this support level. Check this out. There was a massive bullish candle with high buying volume at almost the same price level where our pin bar just formed. This is super suspicious because it suggests that the same institutions who drove the price up earlier are back at it again. Now let's analyze the bearish candles leading up to the pin bar. See that? The selling volume is gradually decreasing and the price range is tightening. This is a major clue that the market is finishing its exhaustion phase and gearing up for its next bullish move. And then boom! The very next candle is a strong bullish candle with buying volume just as high as the pin bars. That right there is our confirmation. The market has agreed it's time to continue the bullish trend, and that means it's time to jump in. Here's the plan. Enter a buy position at the open of the next candle. Set your stop loss just below the support area for protection. And then let the market do its thing. And boom, price takes off exactly as expected. Guys, I hope you're really soaking this in, because I'm breaking this down in the most detailed way possible. But don't worry, if you still have doubts, I've got more real market examples coming up. By the time you finish this video, you'll be trading like an elite market analyst. The more you understand this, the faster you'll master the markets and start developing your own advanced strategies. Alright, let's move on to Anomaly 2. Low buying volume, but a massive bullish candle. Alright, picture this. You're looking at your chart, and bam! A huge green candle appears. Price is skyrocketing, everything looks bullish, and you're about to FOMO in. But wait, something's off. The buying volume is low? How is that even possible? Is this a strong rally or a massive trap? Well, let's break it down, because if you don't understand this, you could be walking straight into a trading disaster. Understanding the key elements. 1. The massive bullish candle. What it is, it happens when the closing price is way higher than the opening price. Basically, it means that in that time period, price shot up. What traders think? Normally, traders see this and go buy, 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 because they think buyers are in control. But hold on, we need to check something first. 2. Low buying volume. What it means, volume tells us how many transactions are happening. So if price is flying, but buying volume is low, who is really pushing this price up? So, what happens when you combine them? 1. Is this move actually strong? What's happening? A giant bullish candle prints, price looks unstoppable. But if there's no real volume behind it, this move might be weak and fake. So danger! Fake momentum. It looks powerful, but without solid volume backing it up, it might not last. High false breakout risk. If just a few big players are moving the price up, they could pull out at any time, boom, price crashes. Now, let's test this in real trading. We're about to see a real example of this anomaly in action. Low buying volume, but a massive bullish candle. Take a look at this chart. We have a strong resistance area right here. This is a highly respected price level. Every time price moves up and gets near this zone, it bounces back down. This area has consistently acted as a barrier, making it a key resistance level that traders pay close attention to. But then, something weird happens. Price moves up toward the resistance zone, and suddenly, boom, a massive bullish candle appears. Now, beginner traders, they see this and immediately think, breakout, price is going to skyrocket past resistance. They believe the market is about to explode upwards, breaking past this level and forming a brand new key price point. But pro traders, they see things differently. They don't just look at the price action, they always check volume. They know that true breakouts need strong volume support. So, what do? They analyze whether this move is backed by real market participation or if something shady is going on. And sure enough, look at the volume! This strong bullish candle is actually running on lower trading volume than previous bullish candles, even the small ones. Hold up! If this massive bullish move was real, the volume should be higher than the smaller bullish moves before it, but instead, it's lower. This is a huge red flag. Why? Because low volume means fewer traders are actually pushing this price up. That tells us this move might not be as strong as it looks. So what do? We do not enter a buy position yet. Instead, we wait for the next candle to see if this move is legit or if it's a trap. And just as expected, bam! The next candle is a massive bearish candle with high selling volume. This tells us that market participants prefer to sell rather than buy at this resistance level. And if you look at the very beginning of this resistance zone, there was a massive spike in selling volume back then too, with a big bearish candle. That's a huge clue. That means the same big sellers who pushed price down before are likely stepping back in right now. What's the move? It's time to enter a sell position. As soon as the next candle opens, we execute a sell trade. But wait, we're smart traders, so we manage our risk. We place our stop loss right above the resistance area, and then, boom, price drops fast. You're not just looking at market structure, you're seeing the soul of the market. You're reading its energy, its motives, its psychology. And you know what that means? You're now a market analyst. Let's move on to anomaly number 3, high selling volume but a small bearish candle. Anomaly number 3, high selling volume but a small bearish candle. Alright, pay attention because this one is super important. What happens when the market shows massive selling volume, but instead of a big drop, we only get a tiny bearish candle? That's weird, right? A ton of selling pressure should push prices down aggressively, but it's not. Something big is happening beneath the surface, and if you don't understand this, you could be trading blind. Let's break it down step by step so you can master this market anomaly and trade like a pro. Understanding the core elements. 1. The small bearish candle. A bearish candle forms when the closing price is lower than the opening price. If the candle is small, it means that while price did move down, it didn't drop by much. General interpretation. Normally, a small bearish candle means sellers are trying to push the price down, but something is stopping them. Could it be strong buyers stepping in? Could the market be hesitant? Let's find out. Chapter 2. High selling volume. Volume measures how many transactions are happening in a given period. High selling volume means there's a lot of sell orders coming in. General interpretation. Normally, when selling volume is high, we expect a big bearish candle. But here's the weird part, we're not seeing that. That means something else is going on behind the scenes. Final takeaways. When you see high selling volume but a small bearish candle, remember, sellers are active, but buyers are holding the price up. The market may be in a state of balance, meaning no clear trend yet. It could be a bear trap. Wait for confirmation before entering a trade. Always combine volume analysis with other indicators to make smarter decisions. Now, let's test this in real market conditions. We're about to analyze a real example of this anomaly. High selling volume, but a small bearish candle. Over here on the left, we can see 4 candle wicks stopping at the exact same price area. And guess what? None of them can break lower. What does that mean? It means the market does not want price to drop below this level. Instead, the market is telling us, hey, this is a strong support zone and we want price to go up. And sure enough, boom, the price rockets upward almost effortlessly. So what does this tell us? This area is super important to the market, meaning we can now officially mark it as a strong support level. But here's where things get really interesting. Price eventually comes back down toward this same support level. And as traders, we never know for sure if price will break through the support and keep falling or bounce off and continue its bullish trend. And then it happens! Anomaly number 3, high selling volume, but a small bearish candle. Look at this, insane selling volume is coming in, yet the candle barely moves. Remember, what we need to focus on is the candle body. The body of the candle shows how much the price actually changed. Big candle body, that means a significant price move. Small candle body, that means price barely moved at all. So what does this mean? The big reveal! Buyers are absorbing sell orders. Even though there are a ton of sell orders, as seen by the high volume, buyers are stepping in and absorbing all that selling pressure. So instead of price crashing down, it barely moves. This tells us something huge. This support level is being defended by buyers with full force. So now we can make a temporary conclusion. The market does not agree on pushing the price lower. Buyers are still active in preventing the price from breaking support. The market is in a battle and the final decision hasn't been made yet. So what should we do? We wait. We need to see what the next candle will tell us. And here it is! The next candle forms and boom! A strong bullish. But wait! Something weird happens. The buying volume on this candle is actually lower than the selling volume on the previous one. What does this mean? It means sellers are exhausted. They tried their best to push price down, but because buyers absorbed their orders, they ran out of energy. That's why price now moves up so easily. Now, check this out. Here's something even crazier. Look at this candle right here. A doji? But hold up, we don't need to memorize candlestick patterns. What we care about is the meaning behind them. And this doji? It's a sell candle with an extremely small body. Now, take a look at the selling volume. It's massive. Wait, what? How can sellers be selling so aggressively, yet price isn't dropping? This is a huge red flag. Something suspicious is happening, and we need to analyze it right now. And sure enough, look at this. This weird anomaly happened at the exact same support zone as before. So what does this tell us? It's simple. Sellers are fighting hard, but buyers are absorbing everything. The market is battling for control, and this support area is where the war is happening. But wait, there's more. Take a look at the candle before the doji. A small bullish candle, but with insanely high buying volume. What does this mean? Buyers tried to push price up, but sellers absorbed their orders. That means sellers were still trying to bring the market down. This is war. So what should we do? We wait. We need to see the final decision of the market. Who will win this battle? And then the final candle forms. Buyers win the fight. Sellers are completely exhausted. The proof: price shoots up effortlessly, even with just normal buying volume. That's it. That's the final verdict. Buyers are the winners. So what's the trade? Since this battle happened at a strong support level, we now have a clear trade setup. If buyers won, we have a high probability trade. We enter a buy position at the opening of the next candle. We set our stop loss below the support area to protect our capital. And boom, price explodes upward. That's how you trade smart. You're not just looking at price movements, you're seeing the hidden energy of the market, the psychology of traders, and the true power behind every candle. Now let's move on to anomaly number 4. Low selling volume, but a massive bearish candle. You do not want to miss this. Let's go. Anomaly number 4. Low selling volume, but a massive bearish candle. Alright, traders, what happens when we see a huge bearish candle, price dropping like crazy, but when we check the volume, selling volume is low? That's weird, right? Normally, a big bearish candle means sellers are in full control, right? But if the volume is low, who's actually selling? That's exactly what we're about to break down, and trust me, you need to understand this before making your next trade. Let's dive into the details and figure out what's really happening behind the scenes. Understanding the core elements. 1. The massive bearish candle. A bearish candle forms when the closing price is way below the opening price. If the candle is huge, that means price dropped significantly within that time frame. General interpretation. Normally, a big bearish candle means sellers dominated the market, pushing prices down hard. But here's the catch. This time, volume is low. 2. Low selling volume. Volume measures how many trades are happening. Low selling volume means that even though price dropped a lot, not many sell orders were actually executed. General interpretation. Normally, high volume confirms strong trends. But when we see a huge price drop with low volume, that's a red flag. It means the move wasn't backed by real market participation. You see this chart right here? Check it out. The price moves up, then down, but wait, it jumps even higher. Boom! That right there is an early sign of a bullish market structure. But hold on, then the price dips again, showing a phase of exhaustion as it moves toward the nearest support area. And this is where things get crazy. We've got a long bearish candle, much bigger than the previous ones, but guess what? The trading volume is actually smaller than before. That, my friends, is what we call an anomaly. And trust me, traders need to pay attention to this because it's happening right around a key support zone. It's almost like the market is rushing to hit that support level. Now, 2 things can happen here. If right after this, sell volume explodes and the price smashes through the support area, then we're looking at a strong bearish trend forming. Why? Because even with low sell volume, the price was already dropping fast. So imagine what happens if the sell pressure ramps up. If that support level gets broken, it's game over. The price could plunge even further. But wait, there's another scenario. What if this giant bearish candle with low sell volume is actually a trap? A classic fake out designed by big market players who temporarily can control the price. Think about it. Just because we see a huge bearish candle doesn't mean the market is actually crashing. Sometimes it's just a short-term trick to drive the price down quickly, hit that support, and then boom, send it flying back up. Why? Because this creates the perfect psychological setup to convince traders that the bullish trend is still alive, making it easier for the price to climb. Smart, right? And what happens next? Bam! A bullish candle forms, pushing the price right back to the opening level of that massive bearish candle. And the volume? Turns out the buying volume is now bigger than the sell volume from the previous bearish move. So is this our buy signal? Not yet. Even though buy volume is stronger, the price has only recovered to the same level where that bearish move started. That means sell pressure is still there. We need more confirmation. We need to see what happens next. And then, boom! A strong bullish candle explodes past the previous higher high, backed by a massive surge in buying volume. That's it. The market just made its choice. From everything we just analysed at the support level, it's clear that the majority of traders are now going long, continuing the bullish trend. And structurally, this creates a new market structure, a higher low and a new higher high. So what do you do now? Simple. Open a buy entry with a stop loss right below the support area. And just like that, boom, the price rallies smoothly. But hold up, the market movers aren't done playing games. Look at this. Another strong bearish candle forms, but guess what? Low sell volume again. Super interesting, right? Now analyze this for yourself. Why does the price climb even higher after this anomaly? I know you've got this, because if you've been following my videos, you already understand how these market manipulations work. Alright, listen up. If you haven't watched my video from last week, How Pro Traders Always Win, you need to check it out. In that video, I showed you exactly how pro traders read market moves and use market structure to maximize their profit. That video is the foundation of everything we just analyzed today, so you absolutely need to watch it to fully understand this strategy. Click here to watch it now, or find the link in the description. I've also linked other must-watch videos and key resources that will help you become a successful trader. Alright guys, I'll see you in the next video. Peace!